So good evening. I would like to welcome all of you to tonight's presentation. Our goal at ClearStep Financial is to help educate and guide our clients through our ever-changing financial world and gain a deeper understanding of our financial markets. I believe we will find tonight's presentation educational and informative. Therefore, I'm pleased to introduce our speakers for tonight's presentation. First, I will introduce Adam Hubb, who is our financial advisor from our Minneapolis office. Joining Adam is Nathan Olson, a financial advisor who is located out of our Milwaukee area office. Adam and Nathan are here to share some key information that impacts our financial lives. With that being said, go ahead, gentlemen.
Good evening, everyone. As Carla said, I'm Adam. I've been working in the industry for about 15 years, and I really enjoy teaching people about financial concepts and helping them make decisions to make their lives better. Nathan, I'm going to have you introduce yourself, and then I'll start the presentation.
Perfect. Yeah. Hey, everyone. My name is Nathan Olson. I've been in the industry for the last 4 years since graduating from the University of Oregon. Likewise to Adam, I love helping people and want to make sure that we are putting them in the best position for long-term success when it comes to finances, and looking forward to giving everyone some insight onto some of those beginning steps that everyone can start taking.
Thanks, Nathan. So tonight we're going to cover some financial basics, and those are always good to remember and keep in mind. So if you're new to investing, if you're new to planning your own financial future, kind of take the time to absorb this information, write down questions that you have. We will be taking questions throughout the meeting, and get back with the person that invited you to have some of those questions dealt with on a deeper level. If you are an experienced person with years or just feel comfortable with your financial situation, just kind of enjoy the presentation, check in on your progress. Again, it's always great to go back to those basics and make sure that you are doing the things that you need to do to be financially successful. We're going to stop at a couple of points along the way. You can type some questions into the chat if you'd like, and then at the end of the meeting, we'll have a time to discuss any questions that you have. So, ClearStep Financial, as Carla said, our commitment, passion to teach people, educate about money and finance. We're a very collaborative group of advisors that have different strengths. We have different perspectives on how to manage money, how to educate people, and we really work very well together to make sure that our clients are making the best decisions. We always use a 3-step process, so we never sell on the first meeting. We take time to get to know you and your situation and come up with recommendations that are very specific to your situation. So with that, I'm going to have Nathan cover kind of the basic building blocks of financial security.
Yeah, so as Adam touched on, when we approach our first initial meetings with clients, we do focus on, one, getting to know them, their situation, and everything that is involved in their life, as well as their finances, to get a better sense of what we're dealing with. And then from that, we kind of individualize the practice following kind of these 7 steps, right? Where when we get a brand new investor, someone who's just kind of starting their career, we want to look at those first couple items, right? We want to make sure everyone's maximizing their cash flow, managing their debt correctly, and kind of have a short-term savings of 3 to 6 months, right? We want to make sure those baselines are covered before we kind of extend that kind of long-term investing practice. And those is where 4, 5, and 6 come into play, kind of starting the investment journey with some long-term savings in some retirement accounts or individual accounts, which we'll get into later. But depending on where we are, we want to just make sure all 7 of these steps are focused on. and built upon as we continue the journey, which is an everyday type of adventure, right? This does not happen overnight, and we build with the client and their situation year over year. So how we do this is in three main buckets, and you'll hear us talk about this. That first area that we want to focus on is a short-term bucket, which kind of has your liquid money, right? Your day-to-day, your expenses, your savings, things that you need throughout the year. If you have an emergency, that's kind of where that bucket is important, right? We need money for our daily lives. The third bucket comes into play for that long-term money, right? That retirement accounts, you might be very familiar with your 401k that you annually or monthly invest from your paychecks, or individual retirement accounts, and that is 7 or more years kind of planned out for retirement. And then that middle bucket is really fun, and where I work with a lot of kind of the younger clients who are focused on that kind of wealth accumulation phase. This is kind of the money that we set aside for big expenditures like a house, like a wedding, some of those events that we want to generate some extra interest on our money, but we also want to have access to it before retirement. And so that's kind of a big focus of making sure that they get excited about kind of creating and building this wealth.
So one thing I always remind, especially younger clients of, is that long-term bucket, because of the power of time, and we'll cover this in the next couple of slides, you don't have to put as much of your own money into the long-term bucket. It's about being consistent and doing it throughout your lifetime. And the midterm, as Nathan said, you can really look at that as fun, as things you really want to accomplish along the way, into funding your lifestyle. So it's important to make sure that when we're saving on our time frames, we're also taking tax considerations into account in looking at maximizing that as well. And so there's 3 different ways you can save. You can save through a taxable account. If you have a savings account at the bank, you get a 1099 each year and you have to pay taxes on that. And that's very good for money we need accessible in the short term. As we look at longer term savings, we want to take advantage of different tax programs, tax implications on how we save. So an IRA allows you to get a tax deduction now, but you pay taxes in the future when you take that money out. And a Roth IRA, or in some instances life insurance, kind of flips that on the other side of the coin, and you would not pay, or you would pay taxes now on the money you put in, but then there's no taxes at any point in the future as you take it out and as you handle it correctly. So that's kind of the introductory, some of the basics of what we look at as far as the structure. I don't see any questions at this point, so we're going to kind of transition into kind of that time value of money that I said, and looking at how we create the wealth that we're looking to. One of the most powerful things that we have is time. The value of the time really outweighs almost anything else that you would look at doing. And so one of the ways that we look at describing this is called the rule of 72, and it talks about how money doubles. So if you take your interest rate and divide it into 72, it takes about 18 years for your money to double. So if you are 29. Some of us wish we could be 29 again, and some of us are looking forward to being 29 at some point in the future. But if you put $10,000 away, it would double twice before you got to retirement, and you'd be very excited about your retirement with your $40,000 in savings. Of course, I joke a little bit. It is interesting, right? For the last 10 years, 4% was not a rate of return that we could easily get, especially with short-term money. But now that really has changed in the last year. And so 4 or 5% is really reasonable to expect on some basic investments. But you can also see that it's not really growing or compounding for you in any meaningful way. So if we go to a 6% rate of return, now it only takes 12 years for your money to double. And that doesn't seem like a lot, but in that same $10,000, you now have an extra double, which is now $80,000. If we go to 8%, we get another double again, and that's $160,000. And you can start to see where the power of that compounding really starts to play in. At 12% rate of return, you get 2 extra doubles, and now your one-time investment is generated or has grown to $640,000. So not only have you taken advantage of the time, but you've made the right decisions along the way with how you've invested that money and making sure that it's working for you and setting you up for success. This is simply the math of how interest works, right? We can pay interest on the debt that we have, and we can earn interest on the savings that we have. And we want to make sure that we're structuring both of those things to be most advantageous for us. Switch back to Nathan. We're going to talk about the cost of waiting.
Yeah, and continuing kind of on the preface of mainly this whole presentation is the power of time, right? And this is shown through the cost of waiting through these 2 sisters, Sue and Sally, right? Sue is a sister that starts saving from ages 25 to 45. She's not able to do much, but able to put $100 a month away, which is great, and does this for the next 20 years. Well, Sally, her sister, starts 10 years later, does the same exact thing, $100 a month for 20 years to age 55. And then if we take the return or the total gross of their portfolios at the end at age 65, we see that Sue doing the exact same thing of contributing $24,000 has that nest egg of $94,000, $50,000 more than her sister Sally, who did the exact same thing except waited 10 years. And so this is where we as advisors really want to hone in for our clients, right? It is an emotional game, but the longer we procrastinate or put off, it does make a difference. And so starting early, whether it's when you're first starting your career or in the middle of your career and just getting started, right? The best time to do it is now. And so we just want to kind of reemphasize the importance of that time when it comes into play in these investments. That compounding interest, where you make interest on your interest, is really, really important in this world. And so if we can do anything with tonight, we want to make sure the importance of time in the market is what's truly important. And then on top of this is just kind of a method of making that investment actually happen, right? The idea of $100 a month that Sue and Sally were doing is a method in this world which we call dollar cost averaging. It's the idea that you take a lump sum set of money every month, every year, a set amount of time frame, every quarter, it can be different, and invest that amount no matter what the market's doing, right? If the market's up, you buy. If the market's down, you buy. You just stick with your system and do that continuously. And over a period of time, the average comes out to show that you're getting a better price for whatever units you're buying and can increase your total return. In this example, you see someone contributed a lump sum investment of $800 over a 9-month period. We had a rocky roller coaster. And so they didn't earn anything at the 9 months. But in the other example, we have someone contributing $100 a month for that 8-month period, and we show their return 4.07%. So think of this on that extended time frame where it's multiple years. And this is where the importance of consistency and sticking to your plan that you and your advisor set up rolling in, and what is very important. Any additions on that, Adam, that you want to add?
Yeah, one of the key factors on this is that by doing the same investment amount on a regular basis, when the market's down, you actually buy more shares, right? We sometimes joke that people love getting things for a deal, right? Getting things at a discount, except when it comes to investing. And as soon as the market drops in value, it feels like it's time to stay away. But this system allows you to kind of take that emotion out of it, and the same amount allows you to buy more shares when the price drops. It's also good to remember that most people do this on a biweekly basis with their retirement account through work, whatever account that is. Every single time you get a paycheck, a little bit of that is going into a 401k, and it ends up using the dollar cost averaging. So still no questions here. We're going to switch over to some key considerations as we look at that long-term investing, right? So we've kind of covered some basics of your financial picture. We've covered some time value and some things that you would want to look at and make sure you're taking advantage of the time in different ways that you can save on a regular basis. So this is the S&P 500. Some people are very familiar with this. Many people know the name because you might hear on the radio on your drive home from work every night that the S&P 500 moved by X amount. And it just ends up being a data point that you hear on a regular basis. And so this is just basically the best grouping of stocks. It's the 500 biggest companies in the United States, and it's kind of looked at as how the entire economy is doing. It is one of the ways that we do in return, but it can be a pretty bumpy ride, as you can see. Again, if you remember back to the late 90s, or if you remember 2008, or if you remember COVID, hopefully, those were times where the market had significant drop in value. And I always remind clients that we're really not looking at that up and down, but we're looking at a long time investment and drawing a straight line through the graph and knowing that at points the market's going to be much higher than that trend line, and at points it's going to be lower than that trend line. But we're looking at capturing the basic upward trend of the market as we invest clients' dollars. Of course, very few clients are comfortable with a ride like this. And so the ride can be very bumpy, but we want to make sure that we smooth it out as much as possible. So one of the things that we can do is called diversification. And that simply means instead of investing all of your money in one specific area, or for some people in one specific stock, if they like to try and play around and pick things on their own, we diversify by investing in a number of different things. And so you can kind of see, if you follow that white box, that sometimes it ends up a little bit higher, but it's an average, right? It helps to diversify and smooth out that rate of return. If there's any other box that you follow, sometimes they're at the very top and sometimes they're at the very bottom, as far as how they fall into the performance. And so simply using diversification can smooth that ride out and can make it easier to stay invested, because we want to avoid that emotion. And we're going to start to talk about some of that emotion of what happens when the market drops in value and what are the decisions that we make during those time frames.
And just as Adam was touching on, the one thing that comes into play more than people realize is the emotions behind investing, right? We have this market cycle that Adam was just able to show in the inflection point slide, but no one really tends to realize how this impacts the actual emotions that the investor faces better than financial advisors ourselves, right? We experience the day-to-day of clients calling when they're in that fear cycle, when they are experiencing these drops in the market, and it is our job, and what we are trained to do is help them navigate these emotions, right? Understanding that this is just part of the cycle, and that as long as we continue with that systematic approach and long-term focus, it does get better. And so just not letting anyone kind of fall victim to, hey, we're at a bottom, let's never do this again, let's be out of the market, let's be in a bank for the rest of our lives, right? That is what our job is to protect against. And what happens, right? Many people fall victim to this situation of having their emotions win, and during a market cycle, sell out at the bottom and let those losses truly impact their situation. Wizards have your back. And how this is kind of shown is it is important for us as advisors to kind of show that long-term impact. This slide shows some of the roller coasters that investing can have. When you look at a 1-year time period for these investments, you can see a potential loss or gain of 47% up to 39% down. That is stressful for anybody, right? No one wants to kind of see that rocky roller coaster. But as you see, the time goes on and kind of that diversification that we touched on makes that roller coaster not as scary and not as intense and more of an enjoyable, lazy river that you can just enjoy. And so we want to focus when we have clients and get in these situations that we set up their expectations, right? You might see some of these volatile swings in a year's time frame. But as long as we kind of expand and look at the long-term time horizon, that's where kind of we get back to the equilibrium and the growth that the markets have shown that they return. So, and this is a last slide that kind of incorporates all that emotions to kind of the returns that you see, right? We're able to look at a 20-year asset class and show that the S&P 500 has returned 9.5%, right? However, when we look at the average US retail investor, their return is only 3.6%. This is proven time and time again with studies like this, where the emotions come into effect more than people realize, right? Even the people that say, hey, I have my money situated, I know how to handle it myself, they are missing out on lots of opportunities, whether it's being too scared or too aggressive, right? Their rich can return. They're looking at the 3.6% because they let emotions come into play. And so as advisors, our main job is to not let that happen.
Thanks, Nathan. Those are some of the biggest things that we do to help clients out. Is we set up, we make sure things are positioned correctly at the front end, and then we walk with our clients along the way as those things happen, and make sure that we remind people they're still on track, that it's part of the process, and that it's okay when markets drop in value or experience the negative returns, experience things we don't want to see. Part of that is just the math, right? The impact of losses. As we look at accounts dropping in value, it takes a lot of time to get back to even. And so the bigger the drop, the more you have to do to get back to even. So a 10% drop in value means you have to get an 11% of rate of return before you're back to zero. A 25% rate of drop in value means you need a 33% return before you're back to even. And if you lost 50% of your value because of market conditions or because you were too aggressive, it takes 100% rate of return to get back to even. So if you had $1,000 invested and it dropped to 500, to go from 500 back up to 1,000 is 100% rate of return. So it's part of what plays into those investment choices that we make. It actually also works out in our favor to not have the same volatility as we look at a couple of different portfolios. If you put some money in the first year, you lost 40%, it'd be really hard to even stay in that investment. But let's say you were convinced that it was still a good place to be, and as often happens when markets drop, they turn around and they recover, and you can get some really good positive returns as it recovers and comes up on the upside. But a 40% gain on your 60,000 means you're at 84,000, and a 20% gain means you're at 100,800. So after 3 years, you're actually not in a totally awful situation considering how volatile markets can be. But your 6.6% average rate of return resulted in an $800 gain. If we can simply smooth out the ride and we can reduce drops on the negative side of performance, we don't have to get as nearly as much on the upside. So if you had a 10% loss in value that first year, followed by a 15% and a 15% gain. Now you underperformed both years 2 and 3, but you don't have to work to catch up. You don't have to recover the losses that you had in that first year. And so you go down to 90, and then you go up to 103, and then you go up to 119. And the amazing part of this is that you still got a 6.6% average rate of return, but you're now showing a really healthy gain for those 3 years. And so it's kind of important to remember what's most important, right? Are we most dictated by our average rate of return, or are we most interested in seeing our account values go up? And at the end of the day, we obviously want to see a higher account value on their statements as we get them on our periodic basis. So those are the things that we had for you today. We definitely want to take some time to answer any questions that people have. And I believe Carla was going to stop recording at this point.